This is not financial advice, educational content only. The headlines on most earnings calls lead with revenue growth and adjusted EBITDA margins. The things the headline writer doesn't touch: accounts receivable, inventory, accounts payable. Those three balance sheet lines, combined, tell you something the income statement can't: how long it takes a business to convert $1 of input cost into $1 of collected cash. That number is the cash conversion cycle. Today we're walking through how to calculate it directly from a 10K, what it means when those components move year over year, and one footnote disclosure, now required under recent FASB guidance, that can make a company's working capital look materially better than it actually is. Let's look at what the filings say. When a company reports quarterly results, the investor presentation leads with revenue, gross margin, and some version of adjusted operating income, usually adjusted to back out non-cash items like stock-based compensation or depreciation. These are income statement numbers, and they're the ones that drive the analyst note and the headline the next morning. The balance sheet gets much less coverage in most earnings write-ups, but the balance sheet is where working capital lives. The three items that matter for the cash conversion cycle are accounts receivable, which is money customers owe the company, inventory, and accounts payable, which is money the company owes its suppliers. None of these flow through the income statement directly. A company can report record quarterly revenue while simultaneously letting receivables balloon and inventory build. The revenue is booked according to its accounting policy, but the cash hasn't arrived yet, and in some cases may arrive on terms that weren't the original plan. That gap between reported income and actual cash collection is what working capital analysis is designed to surface. That's my read. The cash conversion cycle is the single ratio that compresses those three balance sheet lines into an answer to one question: how many days of cash is this business floating at any given time? The formula is CCC equals days sales outstanding plus days inventory outstanding minus days payable outstanding. Days sales outstanding, or DSO, measures how long customers take to pay. You compute it by taking accounts receivable from the balance sheet, dividing by annual revenue from the income statement, and multiplying by 365. If a company carries around $500 million in receivables against $3 billion in annual revenue, DSO is roughly 61 days, meaning on average, cash from sales takes about 2 months to arrive. Days inventory outstanding, DIO, measures how long inventory sits before it's sold. Take inventory from the balance sheet, divide by cost of goods sold, multiply by 365. Days payable outstanding, DPO, measures how long the company takes to pay its own suppliers. Accounts payable divided by cost of goods sold times 365. Subtract DPO from the sum of DSO and DO to get the CCC. A lower number means cash cycles through faster. A negative CCC means the company is collecting cash from customers before it has to pay suppliers. The supply chain is effectively financing the business's working capital needs. That structure depends on maintaining leverage with both sides of the transaction, so it's worth noting how it's sustained, not just that it exists. That's my read. All of these inputs come directly from the balance sheet and income statement in the 10K filing, typically found in the financial statements section of the annual report. A single year's CCC number tells you the current state. The trend over 3 to 5 years tells you the direction of the business. DSO expanding, say from roughly 42 days to 58 days over 2 or 3 years, means customers are taking longer to pay. That can happen for several reasons. The company extended more favorable payment terms to win or retain customers, collection efficiency is deteriorating, or the business mix shifted towards slower paying customer segments. None of those scenarios are automatically disqualifying, but revenue growth accompanied by expanding DSO deserves scrutiny about whether the underlying revenue quality is what the top line number implies. That's my read. Some of that growth may be conditional on terms that compress cash conversion. DIO expanding means inventory is building faster than cost of goods sold. That often signals demand softening before it shows up in the revenue line. because companies typically continue producing or ordering at prior rates while actual sell-through weakens. In goods-oriented businesses, balance sheet inventory buildup has historically appeared a quarter or two before revenue growth starts to slow. The MD&A section of the 10K will sometimes address this directly. Look for commentary about inventory levels, channel fill, or order patterns. DPO compressing, the company paying suppliers faster, can reflect lost negotiating leverage, a deliberate relationship decision, or the unwinding of a supplier finance arrangement. Each of those has different implications, and distinguishing between them matters for how you read the working capital story. That's my read. Here is the balance sheet item that most often goes unaddressed in earnings coverage. Supply chain finance, also called reverse factoring or supplier finance programs, works like this. A company arranges for a bank or financial intermediary to pay its suppliers early. The suppliers get their cash sooner than the original terms. The company then owes the bank rather than the supplier, typically on extended terms. The company's DPO looks longer, its CCC looks better, but the underlying payment obligation is still there. It has been reclassified, and in some program structures, moved off the standard trade payables line entirely. The Financial Accounting Standards Board addressed this disclosure gap with ASU 2204, formally titled Liabilities. Supplier Finance Programs, a subtopic 405 FIFSIF. Disclosure of supplier finance program obligations. For most calendar year companies, this disclosure requirement applied beginning with fiscal year 2023-10 filings. The required disclosures include the outstanding obligation amount confirmed under these programs and where those amounts are presented on the balance sheet. In practice, this means recent 10Ks now contain an explicit note. Look in the notes to financial statements, typically near the accounts payable or debt disclosures. That will tell you directly whether extended payables are backed by a third-party finance program. If a company carries a meaningful supplier finance program balance and that program were to end or be curtailed, DPO would likely compress rapidly and the CCC would lengthen, meaning the business would need additional cash to operate at the same scale. That's my read. The disclosure is there in the filing. Using it in working capital analysis is a step that a lot of screen-level analysis still skips. One of the more practical applications of this analysis is peer comparison within the same industry using data from the same reporting period. If every company in a given sector is showing DIO expansion over the same stretch of time, that's more likely a demand signal at the industry level than a company-specific execution problem. In goods-oriented industries, inventory builds in balance sheets have historically appeared before the revenue growth rate starts to compress. The income statement tends to lag the balance sheet in those situations. That's my read. When one company's CCC is improving while peers are deteriorating, that's worth examining more closely. It could reflect stronger customer relationships, shorter DSO, because customers trust and prioritize paying that vendor. It could reflect genuine inventory discipline. It could also reflect more aggressive use of supplier finance programs relative to peers, which the ASU 2022-04 disclosures now allow you to check directly, for the first time, in a standardized way. The direction of change and the peer comparison matter more than the absolute CCC number. A business running a 90-day CCC that has been compressing for 3 consecutive years is a different conversation than one running a 60-day CCC that has been quietly expanding. Context from the same sector, same reporting period, is the denominator that gives the number meaning. That's my read. Here's the actual tool. Next time you read a 10K, calculate the cash conversion cycle for the current year and the 2 years prior, balance sheet and income statement, roughly 10 minutes. Then check the notes to financial statements for supplier finance program disclosures. Post-2023 filings will have them explicitly if those programs exist. If DSO is expanding while revenue is growing, that's the question to bring to the next earnings call. The income statement won't surface it on its own. This isn't advice, it's a way of looking. If the framing helped you read the next 10K differently, That's the win. I'm Diane, back next briefing.